Welcome back to the Deep Dive. We're here to take that huge stack of earnings transcripts and analyst notes and boil it all down to what you actually need to know.
And today we are digging into Lovesac, that's ticker LOVE, right after their Q3 fiscal 26 earnings call.
And this one is so important because, look, this was not just another quarter.
No, not at all. Lovesac is trying to navigate what their own management calls a sustained multi-year downturn in home furnishings. So this quarter was really a total strategic reset.
A huge pivot. And that's why the market reacted, well, so cautiously.
Exactly.
So that's our mission today. We need to unpack this clash. You have the immediate pain on one side, the soft numbers, the margin hit, and then on the other.
You have these genuinely bold, long-term strategic moves that got completely overshadowed.
Especially that pivot to domestic manufacturing. We have to talk about that.
The short-term pain versus the long-term plan, that's the tension, and we're seeing it everywhere in retail right now.
Okay, so let's start where the market started. The results. These are the headline numbers that really drove that immediate stock drop.
Go for it.
Lovesac posted revenue of $150.2 million. That was a miss. Consensus was looking for something closer to $154.2 million.
Which means growth was basically flat, just 0.2% year over year.
And that tiny bit of growth, it just wasn't enough to cover the rising costs. Profitability took a serious hit.
A really serious hit. The GAAP EPS came in at a loss of 72 cents, also a miss. But the real alarm bell for me was the adjusted EBITDA.
Right. Tell us about that swing.
Well, it went from a positive $2.7 million last year to a loss of $6.0 million this quarter.
Wow.
That kind of reversal, it tells you exactly where the financial pain was.
And it was squarely in the gross margin. We saw a big contraction there. It dropped 240 basis points year over year, landing at 56.1%.
And the other key metric, omnichannel comp sales, that ticked down by 1.2%. You know, for a company that's been a growth story, any negative comp is going to get Wall Street's attention.
So let's get into the why. What was behind that margin erosion?
Management was actually very clear about this. That 240 basis point drop was, well, largely external. They pointed the finger directly at inbound transportation and tariff costs.
And they quantified that, right?
They did. They said that alone had a 320 basis point negative impact.
That is a staggering headwind. So what you're saying is, even with all their internal cost-cutting and vendor negotiations.
Right. Even with all of that, they were basically running uphill against shipping volatility that just wiped out all their wins.
Which connects directly to what they're seeing from the consumer.
Precisely. They used the phrase meaningful choppiness. Said the pressure was worst on transactions under $6,000.
So people are still buying, but maybe they're trading down, or they're just waiting for a big sale.
Exactly. It's a tough environment. But, and this is their key point, they insist they are still gaining ground.
How so?
They estimate the whole furniture category declined about 2% in the quarter and 4% year to date. So the fact that Lovesac managed to stay slightly positive
At plus 0.2%.
It means they are outperforming their peers. They're sort of the strongest swimmer in a shrinking pool.
But, and I think this is the most important signal they sent, they are not counting on a recovery.
Not at all. They were so explicit about this. They said they are not building any plans based on a consumer rebound in the near or even medium term. That's a very defensive posture.
It's the only responsible position, really. I mean, after years of category decline, you have to pivot your strategy.
They're moving from a when the market recovers plan to a what do we do if it never recovers plan.
And that realism is what brings us to the strategic reset. This, for anyone following the long-term story, is the biggest news from the call.
The new focus is to, in their words, harvest the brand. Double down on their core living room franchise, the Sactionals and the Sacs.
Which means delaying the big expansion plans.
That's the trade-off.
Yeah.
The launch of that next major new room category, that big growth driver everyone was waiting for, has been deliberately pushed out.
Pushed out to early calendar 2027.
Right. They're basically saying, let's fortify the castle before we try to conquer new lands and wait for a stronger consumer to show up.
And that's reflected in their store plans, too. They're hitting the brakes on physical expansion.
Temporarily, yeah. They're only planning for about 10 net new openings in fiscal 2027.
Yeah.
It's all about preserving cash and optimizing what they have.
But even while they're delaying the big new room, they are innovating within the core. We're getting the new PillowSac Chair Junior right away, a new swept arm for Sactionals.
And they said fiscal 2027 is actually expected to be their most prolific year ever for new products. But within that core living room category, they're just innovating closer to home.
Which leads us to what you call the anchor of this whole reset.
I really think it is this massive operational pivot to domestic manufacturing for Sactionals. I mean, this is a potential game changer.
So tell us more about this. It sounds like way more than just, moving a production line.
Oh, it is. They're aiming to start U.S. manufacturing for their core Sactional parts by next summer. And to do it, they had to completely redesign the chassis of the product itself.
New materials and new design.
Exactly. New materials for durability, and this is the critical part, a redesign for significantly higher automatability right here in the States.
Which answers the big question, right? How do you manufacture in the U.S. with higher labor costs and not kill your margins?
That is the genius of it. The automation is key, but their ambition is for this entire shift to be gross margin neutral to potentially even favorable.
How is that even possible?
Because the automation minimizes the labor cost difference. But more importantly, you eliminate the massive cost and volatility of inbound shipping and tariffs, the very things that just cost them 320 basis points of margin. This move creates stability.
So it's a defensive play that neutralizes their single biggest risk. And you get new patents and IP protection from the redesign. It's a brilliant supply chain move.
It creates an IP fortress around their core product. And they're backing it up with customer experience improvements, too. The new scheduled room of choice delivery.
And they're testing white glove delivery and assembly. For a big ticket item like a Sactional, reducing that last mile friction is huge.
It's essential.
Okay, so let's bring it back to the investors. The numbers were soft. The strategy is bold, and the stock closed down almost 8% on high volume. The market just seems to have focused on the delay and the margin hit.
It's that short-term thinking, right? They completely looked past the positive signs like management confirming encouraging momentum on Black Friday and Cyber Monday.
They even set a record on Cyber Monday.
Didn't matter. The fear from the tariff impact and the cautious guidance, it just won the day.
On the bright side, the balance sheet is solid. No debt on the credit facility. And they plan to lower inventory. They have the financial strength to pull this off.
So let's look at that guidance. For the full fiscal year 26, they're forecasting net sales between $685 and $705 million.
And then Q4, the big holiday quarter, is always the one to watch.
It is. And they're projecting a strong but cautious Q4, net sales of $236 to $256 million. Adjusted EBITDA between $51 and $56 million.
But there's a catch in there.
There is. They're expecting to be more promotional because of tough comparisons from last year's holidays, which is why they guided Q4 gross margin down a bit to between 57.5% and 58.5%.
So boiling it all down, what are the catalysts we should be watching for over the next year?
First, you have to see if that post-Cyber Monday demand holds up through Q4. But strategically, it's all about the execution of that domestic manufacturing timeline. That is the single biggest risk and reward on the table.
Okay, that's a clear roadmap. Which brings us to the part of the deep dive we call This Is Not Financial Advice.
My favorite part.
We take all these insights and pitch an outrageous but plausible trade idea based strictly on what we've just discussed.
All right, so given how the market reacted, that visceral negative reaction, I think the operational side of this story is profoundly undervalued.
Let's hear the thesis.
The trade is to short the growth stock narrative and long the manufacturing efficiency and IP fortress story. The market sold off because Lovesac isn't acting like an aggressive growth stock right now.
It's not.
But I'd argue that delaying the new room launch is actually a defensive masterstroke. It lets them focus all their resources on making their cash cow product, the Sactional, completely bulletproof.
So you're betting on the operational engineering, not on a consumer rebound.
Exactly. The bet is that management is being overly conservative on the timing and the cost profile of this domestic manufacturing shift. You combine the new IP from the redesign with eliminating tariff volatility.
And you get a faster margin recovery than what they're guiding to.
A much faster and more significant recovery. It could push their margins back toward that high end of their historical 55 to 60% range. And this is the key. It could happen independent of what the consumer market does.
That's a huge bet on execution.
It is. The made in the USA Sactional becomes this unique, defensible premium product that insulates them from cheaper competitors. The stock sold off on a tiny revenue miss. The trade is to buy the multi-year strategy that fixes their biggest systemic risk.
What's the biggest risk to your trade then?
Operational failure. It's a monumental task. Moving a core supply chain for a product this big back to the US is it's huge. If the automation stumbles or the savings don't show up fast enough, it could be a major capital drain. But if they nail it, this stock should re-rate on resilience and profitability, not on growth.
And that's really the heart of it, isn't it? Resilience versus growth. So what this all means for you is that Lovesac has made a choice. They're trading that immediate aggressive expansion for long-term durability.
They're focused on winning the living room now, building a deeper moat around their core business, and hoping to time that next big launch in 2027 with a much healthier economy.
So the final thought we'll leave you with is this. Years from now, will we look back on this pivot, this decision to shore up the core and delay the hunt for new revenue, as a brilliant strategic move that created a more profitable, durable company?
Or will it just be seen as a sign of stalled growth that they couldn't overcome? That is the question the market is wrestling with right now.
An excellent point to end on. We'll be watching the execution very closely. And remember, this discussion is for informational purposes only and is not investment advice. Thanks for diving deep with us. We'll catch you next time.